Let this circle represent 1 million investors. This is what all the investors in the US would look like. This is what all the investors in the world would look like. And these are the people who lose money. These are the ones who break even. And these are the investors who actually make money consistently. About 5%. But this seems to be wrong at first glance. Because when you think about it, over the past 80 years, the stock market adjusted for inflation has risen more than 3,300-fold. Our world is more prosperous than ever. Companies are getting bigger and better, and people now can invest in almost everything, from burgundy wine to cryptocurrencies. They can even trade without paying commissions, something that has never happened in the history of investing. And if you want, you can even leverage artificial intelligence to help you make decisions. But despite being more accessible and quantifiable, investing is not getting easier. And if you think otherwise, then it's likely because you haven't been investing for a very long time at all. And if you are watching this, chances are you've been investing long enough to respect what you are up against, and from time to time get frustrated by your investment performance. In this video, I'd like to give you a few entertaining and illustrative examples of how hard investing can be. And I hope that at the end of this video, you will know things about investing that you don't know now, and something among the things you know will make a difference in your life. So buckle up, because this is going to be an exciting ride. Here's a 2-day chart of one stock from July 1st to July 3rd in 1997. On July 1st, it was traded in a split-adjusted 8 cents per share. It was a 3-year-old 700 million market cap company that was not making any profit. It traded 200,000 shares that day, and I can almost guarantee you that at least one investor bought it at 8 cents per share and sold it 2 days later at 10 cents for a 25% gain in 2 days, thinking they were a genius. Well, this may be true in some cases, but certainly not for this one, because the stock they bought is called Amazon.com. We all know what happened next. Amazon.com, over the next 2 decades, will go up over 133,000%. That person or persons that would have bought Amazon on July 1st, 1997, and sold it 2 days later, they didn't realize they were buying into a great business back then. People say you should buy the dip and sell the rip. And you look at this chart. I don't know about that. This looks incredibly painful to me. And I think everyone watching this video right now has at least sold one stock too early. You felt like you sold right before the stock went up 100, 200, 500, maybe even 1,000% or more. We've all been there, and it's incredibly painful. Investing is hard. On August 5th, 2015, Valeant Pharmaceuticals hit $262 per share. It was an $85 billion market cap company at the time. The stock has risen over 500% over the previous 5 years, and I'm sure someone bought Valeant that day at $262, thinking they were buying into a great business that could be held for decades. During this large run-up, some of the smartest investors in the world bought into Valeant. John Paulson and Bill Ackman invested heavily in this company. Sequoia Fund put about $650 million to work, and at its peak, at $262 per share, the Valeant position made up over 36% of the Sequoia Fund. And this happened.
I inquired as to whether or not they were under investigation, and the company confirmed a number of investigations, including this one.
Recently, the Sequoia Fund has been in the news because of its large position in Valeant Pharmaceuticals. Mr. Munger has termed Valeant's business model highly immoral.
Charlie, Bill Ackman really wanted you to speak to him because he said you're doing reputational damage to a company you don't understand. He wanted you to change your mind. Will you change your mind on Valeant?
I don't think so. There's been a complaint about my saying that Valiant is a sewer, but I thought the complaint would come from the sewers. It never occurred to me that anybody would be defending Valiant.
More tears for billionaire activist investor Bill Ackman. Look at Valiant. This is an investment he's been piling up on, plummeting again today, down 15% at this hour.
We've had one problem.
What is that problem?
That problem is Valiant Pharmaceuticals, and the mistake we made is for the first time we bought a company that had an incredibly successful track record. There was already an activist on the board of directors. There was a CEO who had done an excellent job, and we thought we could be a passive investor.
The investigation caused its stock price to plummet more than 90% from its peak. The Sequoia fund ultimately sold out of its position a few months later, in the high 20s. Bill Ackman lost more than $4 billion on Valiant, and John Parsons' firm lost nearly $2 billion. You know, it doesn't matter your background, your fancy education, or your pedigree. I think everyone watching this right now has at least sold one stock too late. You have held it the whole way up and have held it the whole way back down. That experience can be extremely painful. Investing is hard. On April 1st, 1976, Steve Jobs, Steve Wozniak, and Ronald Wayne founded Apple. Wayne designed the first Apple logo. He wrote the three men's original partnership agreement and the first Apple I menu. Steve Jobs and Steve Wozniak each owned 45% of the company, and Ronald Wayne owned 10% of the company.
12 days later, I went down to the registrar's office and had my name taken off the contract.
He sold his 10% interest for $800. In the following months, Steve Jobs begged Ronald Wayne to return and even offered him more equity to return, and Wayne refused. His original 10% interest would be worth more than $254 billion today, which would make him the richest man on this planet. In case you are wondering, yes, he would be even richer than Bill Gates, Elon Musk, and Jeff Bezos. Ronald knew the company and the founders of Apple better than anyone else. He was closer than anyone to the visionaries of Apple, and he still sold. A few years ago, Wayne was asked if he regretted selling his share of the company, and here's what he said.
No, I never regretted taking my name off the contract. Not once.
Ronald is 88 years old now. He's living in a rented house in Ohio with a net worth of $400,000. He's certainly not the richest person on earth, but Ronald is happy with his decision, which is a mentality not many people have. You know, sometimes it doesn't matter how close you are to a story. Investing is hard. Masayoshi Son is the founder of SoftBank, and for 3 days in the middle of 2000,
I became richer than Bill Gates.
he is currently the second richest person in Japan with a net worth about $22 billion. However, Masayoshi's start in life was very bleak. He was a Korean immigrant born in Osaka, Japan in 1957. He was considered an outsider in Japanese society because of his Korean heritage, and his Japanese classmates threw rocks at him all the time. His family was also very poor. They lived in a shack with the pigs they owned. From an early age, Masayoshi was adamant he wanted to build a better life for himself. By middle school, he decided on his life plan. He wanted to become the most successful businessman in Japan. At the age of 16, he traveled to the United States to take classes. A year later, he enrolled in a college. While still in college, he started 2 startup companies that he ended up selling for around $5 million. He would use that capital to return to Japan and start SoftBank in 1981. Well, long story short, SoftBank was very successful, and Masayoshi started using that money he made to invest heavily in internet companies in the mid-1990s. Over 3 years, he invested over $2 billion across 100 internet companies. It was estimated at the internet bubble's peak in the year 2000, SoftBank owned roughly 10% of the entire publicly traded value of all the internet companies. But then, dot-com bubble bust in 2001. and SoftBank lost 99% of its value from its peak. Masayoshi Son lost
$70 billion of net worth, the greatest loss that any human being has ever suffered financially.
But 2 years before the dot-com crash, he made a very, very important investment. In 1999, Masayoshi made a $20 million investment in a Chinese company called Alibaba. This investment is considered today to be the most successful investment in the history of humanity.
He had no business plan and zero revenue. Employees, maybe 35, 40 employees. But his eyes was very strong eyes, strong, shining eyes. I could tell from the way he talk, the way he look at, he has a charisma, he has a leadership.
SoftBank's $20 million at its peak was worth more than $200 billion. This is a 10,000x return. What's interesting about this is that Masayoshi made over 800 investments like this. He almost went bankrupt, but a few investments saved him.
He probably has the biggest guts in the world on doing investment. Yeah, right. Very few people in the world have that courage.
Too much guts, sometimes I lose a lot of money.
I know.
Investing is hard. In the early 1960s, cigarette consumption peaked in the United States. At that time, roughly 45% of adults in the United States smoked cigarettes. Then, in 1964, the Surgeon General posted the first negative report on smoking's side effect on health.
It is the judgment of the committee that cigarette smoking contributes substantially to mortality from certain specific diseases and to the overall death rate.
Then in 1970, they banned cigarette advertisements on TV. They then doubled the tax on the cigarettes. And then they doubled the tax again. Then in 1986, the Surgeon General reported its negative findings on secondhand smoke. Per capita smoking quickly declined by more than 50%. You look at this chart here and you think to yourself, those major cigarette manufacturing companies had to have been decimated, right? Let's find out. Altria is the second largest cigarette producer and marketer in the world. In 2017, Morgan Housel tweeted out this comment which I thought was brilliant. US cigarette consumption has dropped 44% since 1981. Altria stock is up 71,000% since 1981. Sometimes things in investing just don't make any sense. Investing is hard. Now that I think I have most of your attention, I thought I'd get you to participate a bit in this next example. This is, by the way, a real-life example. The scenario I'm going to set up for you is also real. Here are a company's net revenue income and growth metrics from Q3 2003 to Q2 2004. The information for each quarter runs horizontally. If you look at the bottom row of Q2 2004 across the top column, you see the trailing 12 months revenue, trailing net income, trailing quarter-over-quarter revenue growth, and year-over-year net income growth. Again, this is a real example. During this period, this company here is a micro-cap company. It created its own niche and its category. As you can see, the growth is continuing to accelerate. I could also give you the balance sheet, the cash flow sheet, which are obviously very important. But for the sake of time, let's just say there are no red flags. And this company is traded at a 30 PE. So given what you see here, would you be interested in owning this company? The answer should be yes, you would. Now what if I told you, during Q2 2004, two largest industrial players, one an 80 billion market cap company, and the other a 110 billion market cap company took notice of this category that this small company created and decided to launch their own products into the market. Both of these behemoths have global distribution systems, and they intend to spend tens of millions of dollars in marketing to take market share. So given this new information, how many of you would own this company? Quite a few less. Okay, what if I told you at the same time these two industry behemoths announced their plan to enter the market, the CEO and the COO of this small company sold 26% of their holdings. So just in review, we have a micro-cap company is growing revenues by 40% per year, net income is growing 267% year-over-year, and the growth looks to be accelerating. The company is trading at 30 PE. Two of the industry's largest competitors have taken notice and are entering the market. And the CEO and COO of the company just sold a quarter of their position. How many of you would still own this company? I don't know if I would, but by the judge of it, not many of you would as well. Well then, you would have missed out on the 190 bagger, because this company is Monster Beverage. You know, reading through the history of Monster Beverage just reinforces just how hard investing can be. We're all trained to look for news and reports relevant to our investments, but maybe all this training and hard work that you thought would make you a better investor might be causing you to miss out on a great investment opportunity like Monster Beverage. And I'm not cherry picking here. All great companies and investments, I mean every single one of them, tells a similar story. Investing is hard. Before we get to the conclusion, let's just quickly summarize where we're up to, as we've covered a lot here, and I think we could all use a quick recap. So, it's not always wise to buy the dip and sell the rip. Not always wise to buy and hold. Not always wise to exit investments too prematurely. Not always wise to invest too radically. And not always wise to even try to understand it. But then how did that 5% make money consistently? There must be something we can do, right? Yes, there is, I think. But it requires us to go against our human nature. Because you see, oftentimes it's our human nature that gets us into trouble. Successful investing is counterintuitive. It is a lifelong process of retraining our minds to think differently and better, which is something that the other 95% failed at. If you want to find some shortcuts, equations, or algorithms to beat the market, chances are Mr. Market will teach you a very painful lesson. And the mistakes here are not like the mistakes you made in a school exam. Making investing mistakes could literally destroy a family and generations of wealth. And to make matters worse, you can't learn this stuff from anyone. Not even from gurus like Warren Buffett, Peter Lynch, Jim Simons, or Charlie Munger. Because
the odd thing about it is that people are kind of born deferred gratifiers or not. Lots of luck if you're an impulsive person that has to be gratified immediately. You're probably not going to have a very good life, and we can't fix you.
If Mr. Munger is right, which is very likely, then most people are just not suitable for investing. We can all learn from their wisdom, but remember that whatever these gurus figured out only applies to them, because when it comes down to investing with your own money, these lessons would usually disappear into thin air. And that brings the final point I'd like to make. Do your own work, and don't bother finding the next multi-bagger if you're not going to develop the conviction to hold it. You can borrow someone else's investing ideas, the list of stocks in their portfolios, and even real-time transaction data. But you can never borrow their conviction, and true conviction can only be obtained but trusting your own research over that of others. Of course, you're not going to be right all the time, and it's your job to put in the work and decide for yourself what to do. In other words, when you find yourself blaming others for your investing mistakes, it proves one thing: you didn't do enough of your own work. We often read quotes like this one from Albert Einstein, where he says, "You have to learn the rules of the game, and then you have to play better than anyone else." If you think you have the courage, intelligence, and perseverance to learn the rules of investing, I wish you good luck. But if you don't think you can handle all these ups and downs, and maybe don't have time or simply not willing to put in the work, then investing is probably not for you. Investing is hard, but it's also really, really fun. There's nothing quite like it. You only need to find a few great investments to beat the market, which could literally change your life. The gap between rich and poor is widening every day, and for ordinary people like us who aspire to close that gap, there are only so many options. I'm glad you watched this far. I hope you enjoyed the journey, and I wish you good fortune. I know what a lot of you are thinking right now. Why isn't he mentioning fill in the blank? And I want to hear from you. Like, what are some crazy facts about investing you know about that I didn't mention? Let me know down below. I've got a bunch more videos coming out in the next month, so stay tuned and subscribe if you're not already. All of that being said, I hope you have a wonderful rest of the day.